Hi, my name is Bruce Bolger, and I'm founder of the Enterprise Engagement Alliance, which is an outreach organization dedicated to educating the world on the benefits of fostering a proactive involvement of all stakeholders. And we're here today to provide management at all levels a good 30-minute report on what they need to know about human capital management and reporting. And we're lucky to have experts from almost every aspect of this to share their viewpoints. And then we're starting with Amy Armitage, who's has probably over a dozen years of experience in the whole area of human capital management reporting when it was still barely on the drawing boards. And she's chair of the Human Capital Investment and Reporting Council, which is made up of human capital and human resources experts. And she also is a program director for the conference board. We have Eric Derisaw, who also has, gosh, at least 2 decades of experience, committed to the whole area of ESG. And he is currently a senior consultant for Omni Research Group, which provides investment research and related services for investors in ESG and also diversity, exclusion, and excuse me, diversity, equity, and inclusion. And then finally, we have Nick Shepard, who describes himself as retired, but that's hardly so. He just wrote a book called How Accountants Lost Their Balance. And he's also a CPA fellow for the CPA Organization of Canada. So he has a distinguished career as a chief financial officer. So we're going to get this perspective on what you need to know about human capital reporting from four people who can provide different insights. So Amy, starting with you to give us a historical perspective, given your long-term commitment to it, where are we on the maturity cycle of this move to human capital reporting? And why do you think we might be at the tipping point?
Bruce, thank you. It's a great question. And in terms of the maturity curve, I think we're really just in the beginning. Certainly the waves of change are really upon us for enhanced human capital transparency, reporting and disclosure. But I think that this is really just beginning to accelerate in terms of some of the things we're seeing in the marketplace right now. And I think the choice for many practitioners out there is, you can stick your head in the sand and pretend the waves aren't coming, or you can really learn to surf the waves. We're seeing a lot of change right now, of course, with the S and ESG has become predominant with the pandemic. Certainly, diversity, equity, and inclusion has become top of mind. Many CEOs are beginning to see it as critical. And we're beginning to see sustainability investing, ESG ratings, and attention from major players like BlackRock and State Street and pension funds. So the choice really is to really begin to see the waves of change and then begin to ride these waves of change. And the second thing I think is if you really learn to surf well, this is a huge opportunity for businesses to differentiate their business strategies, to engage their stakeholders, and to really align their business strategy with sustainability goals.
Thank you very much for that. From the accounting standpoint, Nick, um, where do you think we stand in the maturity of the financial industry, recognizing that, yes, indeed, accountants have lost their balance, and what can they do about it? Could you quickly explain that concept and where we're at in the whole concept of accountability reporting, I should say human capital reporting in the accounting field?
Great question, Bruce. Thanks for that. I would say very quickly, the answer is immature. One of the great challenges the accounting profession has is we know that one of the largest costs of running a business is what we pay to people. But we also know that people are the drivers of value in today's business. People, in fact, create processes, products, services, relationships, supply chains, all of the things that are necessary to bring value to an organization today. And there is very little financial disclosure that tells us anything about how much money is going into those areas. But there's a second, much more important issue, and this is really the hidden issue. and I learned this through my time with chairing the Quality Costs Committee of the American Society of Quality, is that when organizations had poor quality, the costs of poor quality were hidden. The financial results really didn't tell organizations what the profit opportunity was from the fact that they were paying a lot of money to people to do things, and they weren't getting good results from it. And once we finally understood the costs of poor quality, then we started to understand the need to invest in quality. And I would say that's where we are today with the whole issue of organizational human capital reporting. And what's unique about it, and I have to give a plug to the enterprise engagement, is that there are two key aspects. The first is what we spend and what we've got. But much more critically is what's the degree of motivation and commitment of that workforce in the organization. And quite honestly, financial reporting tells us nothing about that.
Well, thank you. And Dorian Nunez, I'm so sorry to have forgotten to introduce you because you too have had decades of experience in this whole area of ESG and DEI, diversity, equity, inclusion. But what got you, tell me quickly about, or tell us quickly about your company, Dorian, and what you got you interested in ESG.
Well, our company is an independent research and consulting firm. We work with pension funds, money managers, hedge funds, broker-dealers, and financial advisors. For decades, we've worked on inclusion of minority-owned and women-owned asset management firms. So that partially got us into this. But it really started when I was a student at Harvard Business School, and a woman came and gave a presentation on South Africa divesting, and said that you can create a index fund that does not include companies that are headquartered in South Africa. So this was an overlap of investments, which I was very interested in, and social consciousness, which I had. So that was when the seed was planted, and it's just stuck with me over these decades. And like Amy said, it's now flourishing in a way that's bigger than we dreamed 40 years ago.
And Eric, from your perspective, you're actually the person that reached out to our organization, and for a really fascinating reason that links back to what Amy said at the very beginning about DEI being a business opportunity. Could you just tell us a little bit about that and your thinking behind it? Eric, you might be muted.
Yes, I'm sorry about that. There you go. Part of, like Dorian, I got started as part of South African divestiture. I grew up in the whole corporate governance research area back in 1986 with the Department of Labor. It said voting proxies as part of the fiduciary responsibility of money managers and pension funds. You just can't vote with management. As a result, there's been a lot of work looking at the issue of equal employment issues by investors. And that's where a lot of my work has been for many, many years. How do you examine how a company engages in its employment practices? And just like human capital, there's been a great deal of interest in the employment practices, particularly around minority hiring and diversity and inclusion. And that's been around for some 20 years. And so I've been working with a number of groups, investor groups that have been, advocating similar to what the Human Capital Investor Coalition for greater disclosures in that area. So what we have now today is a very, very interesting, kind of confluence of events between human capital disclosure and the decades discussion with corporations about their employment practices, particularly around DEI.
So would that mean, thank you, Eric, Dorian, would that mean then that we could see an ironic situation where the current focus on DEI disclosures is going to force companies to kind of step back and embrace the whole ESG, or is it the other way around?
Well, I say they go hand in hand. You've got the environmental movement has been very successful in getting not only to the forefront, but also getting places like BlackRock and others where they're creating ESG products. Then you have the social awakening that's going on, and that has gotten people focused on social justice issues. And let's not underestimate the impact of millennials. They're the ones that are driving this more than anything else. I go to CFA meetings now, which is Chartered Financial Analysts Association, and all of the analysts say it's the millennials, it's the customer, it's the consumer that's asking us about ESG and social justice, and that's what's driving it forward. And that's why even when the SEC is having hearings on how do we do ESG disclosure, you've got the big asset management firms in there being supportive of this effort as well. So they're in the future, it might be at least domestically that the S and the G supersede the E because the E becomes so baked into the norm and the growth is in the S and the G side of ESG.
Thank you. Amy, you know, it often seems to me that in business, nothing happens unless businesses have to do something. It's so easy to, you know, get into your groove. With the Securities and Exchange Commission not only now having already issued the requirement that human disclosures be made, now we're definitely hearing that the new SEC is going to be even more activists on the specificity of such disclosures. They've named an ESG attorney, as well. And then we're also seeing it now turning up in the supply chain, where corporations are, saying to their supply chain, we want to see how you're treating people, because as the Bank of America chair, Brian Moynihan says 95% of all companies fail because of human capital issues. So do we see this moving to reporting almost to a need to have?
Absolutely, Bruce. I think the bottom line is the SEC is really, put a major stake in the ground by saying human capital is material. Human capital has an effect, financial effect. So it's very critical that we will begin to have a mind shift, I think, where in the past, labor has been considered, a cost of doing business. We're seeing a mind shift right now to saying human capital is really an investment in the business. And I think DEI has been interesting because DEI has really been at the center of the shift to think of talent as an investment. So to the degree that this is becoming a need to have, a critical to have, I think it really has to do with the wealth creation is really happening through people right now, and it's happening through talent. So that's the shift that's happening that I think is critical, that it's regulatory shift, but it's also a mind shift in the way CEOs and boards are going to be driving and managing their business.
So Nick, I'm sorry?
Glad to see Nick shaking his head, so nodding his head.
So Nick, from the standpoint of it's still going to be several years before the accounting profession really embraces this. And that's a whole nother story. So I'd like to focus more on the nearer term effect of this, because wearing your CFO hat, once you report to something, you have to manage to it. So how will this type of, if companies have to be reporting on how they treat people, how does this affect potentially the organizational management process?
That's a really good question, Bruce. I'd just like to pick up, if I may, on something Amy said, because I think it's so critical here that one of the big problems the accounting profession has, and this is really the whole genesis of the book, is that we have become what's called an intangible world. Even Warren Buffett talked about asset light organizations. The the things that we're talking about, including human capital, are really, as I said, the drivers of value. But think about this. Think about the fact that an organization's reputation and its brand value, which you look at Apple and Google, Alphabet, we're talking about billions of dollars here. The value of their organization depends upon their reputation. And you're talking about millennials. Well, millennials to a great degree are the ones that are going to make those decisions, and whether the reputation is seen as positive or negative. Accountants don't report on any of this. Accountants don't report on the value of a brand or the value of any other intangibles. And these are really the things that drive value of the organization. So one of the things we have to do is completely change the thinking in the accounting profession to recognize and report on the intangibles, and the human capital is a core piece of that. It's really the driver of those intangibles that we create. So reporting of the human capital is only part of the whole question, and yet is a very critical part of it. And quite honestly, I think I will take the leverage wherever we can get it.
And sadly, if we're not really reporting on it and accounting for it, we're not properly managing to it. We tolerate in our people management processes a degree of chaos and lack of measurement that would never be acceptable in manufacturing. And I don't think we'd have a vaccine today for COVID if we used the same processes we use to manage people. Eric,
can I just add, because I think that's
please.
critical, Bruce. One of the issues is that the accounting profession still manages the cost of people.
Oh, we lost him. He's in the great north of Ontario, and we've just lost Nick, we've lost your audio. Hopefully it's going to come back. I'll give it a moment, and I'm going to move to Eric. Eric, one of the frustrations that you expressed to me early on related to this whole issue it's fine. I'm going to shift gears a little bit on this DEI for just 1 second, because the ironic thing about the diversity, exclusion, and diversity, equity, inclusion issue is that it is forcing companies to deal with this issue of the broader issue of ESG. But your frustration that you've expressed to me kind of gets, Eric, to the fact that companies aren't managing properly to this. They haven't addressed how to actually deal with the issue. If we're going to have a domain of reporting, isn't that going to really force us to address the failure to manage properly to achieve these goals?
Yes, I think
Again, we might have you on mute.
Yes, I think part of the issue, particularly when companies are looking at the issue of not only human capital, but particularly around diversity and inclusion, is that they're looking at it as a compliance issue and not a business issue, and an issue that will help them, improve their financial performance, expand market share, improve shareholder returns. Because of the way that it's being treated internally by management, it's kind of let's just cover ourselves and protect our brand because we don't want bad public relations, versus looking at the opportunity in diversity, equity, and inclusion, and having a more diverse workforce, supply chain, measuring the impact of their investments in human capital as a profit center, and a way to help the company grow its business. And so we have to shift from this compliance mindset to an investment mindset. And as my colleague and I have been looking at, from an investor standpoint, yes, they want to see companies, engage in, of course, good business practices, but also they need to understand how that impacts the return on equity. And that's going to be very, very critical. And what Omni Research has been looking at is how do we take the internal practices, show the return on equity, and actually demonstrate that from an investor standpoint, because of course an investor is looking to maximize returns.
Well, that's a great segue to Dorian, because I know your passion is really linking the whole concept of human capital and the element of diversity, equity, inclusion is one element of that, to shareholders' returns. Could you share a little bit more of your thinking about that and where we are in terms of research that investors can use to make sense of all these crazy corporate sustainability reports that are coming out that are completely different? They're all different, incomparable almost, and that's another issue we'll get to. But where do you see this story in shareholder value?
So how much time do we have to cover that? That was a lot of landscape there. but just to be brief, you could see the arc is right here in this group. Nick is right. Accountants used to talk about the cost of people, the cost of labor, and not the return on labor. And as we move to a service economy, people are more important. Well, if you move forward then, speaking about the US, as we have more of a diverse population, men, women, age, LGBTQIA, obviously black, brown, whatever term, demographics, whatever term you want to use, your employees are so important. Companies invest millions of dollars in hiring and recruiting, but they don't invest millions in keeping them happy so that they stay. And so instead of talent acquisition, you have talent abandonment, where they go out the door and they decide to get another degree, they launch their own firms, or they just look for greener pastures elsewhere. And those millions of dollars invested in acquisition walk out the door with them. And so, and companies know this because they always say our assets go in the elevator and leave, but somehow they don't think, they get a blind spot when you start talking about it at the board level, at the C-suite level, and down below. And that's changing because we're asking more information on board disclosures and everything else. So I'm not sure that directly answers your multi-part question there, but I'm happy to take another run at it. But really, we are at the forefront of bringing this to the forefront. Now, there are a lot of scoring systems in the ESG world that measure them, UN principles, all kinds of things. And down here in New Orleans, we call it gumbo, when you mix everything together. And so it's really ESG gumbo. And what we're doing is disaggregating that. You can have a company rated high on one person's ESG rating and low on another. Best example I can give, Core Civic, there's a company that we like to hate. Core Civic runs private prisons. So you would think that that's negative in terms of ESG and social justice, but they have good employee policies. So I had an actual discussion with an ESG portfolio manager who said, oh no, they're included in our portfolio because the employee practices are good. And yet they make money off of misery. So social justice advocates would say, get rid of them. Why do you have this in your portfolio? They also happen to be a member of the S&P 500, to which we say, why? When there's so many alternatives that are less offensive that can be in there as well. So that's the area that we are grooming and working on, making rational sense out of ESG reporting, ESG scoring, and linking it to these ESG mutual funds and investors so that they can make true value-based decisions.
I want to mention
Amy,
maybe a slightly different perspective here in that, you're starting from the ESG ratings investor perspective. If you start from the company practitioner perspective, and I imagine many people listening are from that practitioner perspective, the question is, where do you start? And I would argue that you really need to start with your stakeholders and with your business strategy. So all of these different rating systems are critical, but the frameworks, I think, can sometimes be more confusing, even though I'm a huge proponent of the ISO 30414 standards as a guidepost, a kind of North Star. I think companies have to start with their stakeholders. So they have to have an assessment process of what critical issues and goals are there for your stakeholders, internal and external. And that's a really good place to start, your stakeholders and your business strategy.
Well, gee, that was perfect because you read my mind. That's what I was going to ask you about.
Mind
So
melt.
could you talk a little bit more? It's just incredible. Seriously, I was going to ask you, all right, let's get into the brass tacks now. Companies now have to sit down. We realize if you have probably 50 or more employees within the next year or two, you might not necessarily have it on your financial statement, but you're going to have to start publishing corporate sustainability reports. It's just becoming obvious. When you're required by your supply chain, that usually makes people, do it. So my question to you is just a quick little briefing. We know these corporate responsibility reports are all over the place. A lot of them are fluff, and I'm going to ask Eric and Dorian a little bit about that as well, and what can be done about that, frankly. But what to really create a corporate sustainability report in a nutshell, what should a CFO, CEO do, and who's involved?
Wow, that's also about a 3-day answer. But I think where you do have to start is, what does your business require to be successful? And if you believe that the stakeholders of your business are those that make the business successful, then you start with asking your stakeholders what's critical in terms of 2 things: key performance indicators, those are the goals, but also the key performance narrative. So you've got the indicators, which really tell you what's important in terms of goals, but the narrative is really the story about what's critical, the story about where you are now and where you're going. So, where is your workforce in terms of its safety and wellness, and where is it going? How has it reacted to the pandemic? That's the story. And I think that's as critical as an engagement tool, identifying people with their own story, as even the indicators, perhaps more important. So that's where I'd start thinking about both the measures that are critical, as well as the story that's critical to each of these different stakeholder groups.
And I would imagine the ISO 30414 framework, even if a company doesn't want to get certified, you can buy it for $150 at ISO.org, and it provides you all of the information that they deem to be critical to managing your people business. Isn't that correct?
Yeah, and I think the reason why
So Nick, from your standpoint, keep going.
The reason why it's important is because it's a good guidepost with clear standards and clear formulas behind it, in short.
Yeah, that's right. So Nick, in your experience, do companies, when they have to report on metrics, does that provide the basis, perhaps even changing the incentives that we use with management, so that we can actually demonstrate what's critical through the incentives that our management has? Do these frameworks actually help us rethink what we're motivating people to do?
They should do. Yes, absolutely. Because the old classic, you get what you measure. I think one of the challenges is, and again, reinforcing what Amy said, is that it does start with the thinking process around the key stakeholders. But one of the challenges I've seen, and one of the problems, is that, dare I say, that the financial profession is still bleeding over too heavily into some of the thinking into the ESG reporting. If we look at something like materiality, for example, which is one of the key tests in determining what you're going to report from a stakeholder assessment and review, we're still ending up with what I would call the motherhood statements of, yes, our employees are material to our well-being, therefore we're going to report on how much training we're doing, we're going to report on what our diversity numbers are. But that doesn't really tell me a whole heck of a lot about really how you're investing in your employees as a strategic asset to the business. And again, there are 2 parts of that, not just what it's costing you, but to what degree are these people engaged in the organization? Because the difference is like a 20 or 30% difference on the bottom line, innovation creation. And so I think it's not only developing the metrics, it's somehow we've got to change the mindset as to how we think our way through these metrics. So it's to me, it's quite complex. My concern is that areas like the World Economic Forum, if you look at what they just came out with, we're still, I think, confusing human capital with some of the social requirements, rather than it being about the right way to run your business.
Well, that's a very good, that's something that Dorian had pointed out earlier, and that, really keeping the focus on shareholder returns. And I'm going to get to you in a minute on Dorian, but I'm going to stop by way of Eric, because I know this is something you're passionate about. Is it possible that human capital reporting not only can be spurred by the requirements of companies now to address the more narrow issue DEI, but isn't it also an ironic thing that that it's going to possibly stop the whole concept of diversity theater, which is the new term coming out? All right, I'm going to do diversity now. I'm going to hire somebody, do this, do that, rather than really being committed. Do you think that human capital reporting can force us, as Nick said, to manage to measures and cut out with the bright shiny objects?
Absolutely, I agree with Nick. I think that the way that companies are again approaching the idea of diversity again is a compliance issue. And to be very, very honest, a CEO has the responsibility. Ultimately, he's going to respond to his shareholders, right? Shareholders are asking questions about not only human capital, but diversity, equity, and inclusion. So he's receiving inquiries about both. And it's most of the mindset is a compliance mindset. Let me figure out a way to answer my investors' questions, who are the owners of my company. But they're not thinking about, they're kind of looking at it, the wrong way. They're not thinking about it in the way where now I need to communicate to my investors how I am going about investing in human capital. How am I going about investing in diversity, equity, and inclusion? And what does that ultimately mean to my financial performance? And also, of course, shareholders are looking for returns, right? So being able to have a methodology, not only to ask the compliance questions, but to show the investor community that you actually have a process, a methodology, and that you're measuring it, because despite the social concerns, they want to make money. That's the bottom line. And I think that that's going to require a different level of thinking and a shift from a compliance thinking. BlackRock has come out and said, "Oh, well, we're going to vote against those directors that don't disclose, for instance, their equal employment data in this particular instance." And it just, and again, that's compliance. So they're going to go and going to figure out how to, comply with that, versus thinking about how they're going to communicate to their shareholders on how they're going to make that a business opportunity and a profit center for the company.
And that'll be my last question to you, Dorian. You said something at the beginning of the program I found very interesting. You said that you seem pretty enthusiastic that something's finally changed, that after 40 years, something has finally changed. Do you think that every manager who's listening to this right now, whether they're HR, marketing, sales, or frontline manager, that this new emphasis on people management could potentially affect their jobs and the way they do their jobs? Is this happening now?
Great question. What we should be doing, and I mean we being those of us on this call right now, is informing and educating those managers that they are no longer middle managers in the middle of the organization, or the stepchildren, or whatever term one wants to use. Their activity and their success has a direct impact on investor relations, on the CEO, on the board, on levels of interest in the stock price. And if they embrace that concept and start paying attention to these things that we're saying, they've got greater job importance, greater job security, greater authority There was a time when the information technology guy was just a little person who didn't do a whole lot. Now they've got titles. Now they're C-suite. So I'm gonna make a bold prediction here. We have an accountant, CPA. We have an accountant. We have economists. We have analysts here. In 2 years, we're going to start talking about in the investment literature, how do you project the future stock price, the attractiveness of an investment based upon the ability to analyze how well they groom, invest in, or I was going to say exploit almost, but I don't want to say that word, but how well they manage their human capital, because it's all about the human capital at this point. It's not about the machinery, the technology, and everything else, because human capital creates that technology that everybody uses. And so we are sitting here right now, this group, EEA and those of us, we should be combining our levels of interest, talking about the materiality, creating the methodology for measuring it, and then putting it in front of charter financial analysts, portfolio managers, hedge fund managers, and others, and say, this is how you can get ahead in your investment process because you understand this before others do. And that's what part of what investing is all about.
Well, Dorian, thank you for summarizing our mission so beautifully. This wasn't meant to be an advertisement, but that's indeed our mission. Amy, I'm going to close with you. From the standpoint of my thinking about when a human capital reporting or integrated reporting from the accounting profession really takes hold, it's a unifying process, isn't it? Because human capital supply chain, it's our community, it's everybody, all of our stakeholders. So the very process of doing a corporate sustainability report requires alignment. Could you kind of conclude with how, if you do a human capital reporting process correctly, it actually helps you foster the very alignment you need to make it happen?
Yeah, exactly. And I think the whole point here is that the CSR is actually a process. It's not an endpoint. It's not an end game. It's really a process for bringing together your entire community of stakeholders and understanding what those stakeholder needs are, getting the stakeholders to speak with one another, to build consensus with an organization. So it really is about a journey. And I think it's important to realize, anybody who's just beginning this process right now, beginning with a CSR report, that there will be an evolution. You will start with X, and then you will travel to Y, and then you'll go beyond Z. That begin with something, begin with a journey. Many companies right now are starting with D&I because that's some of the loudest voice, I think, out there. And, whether it's the investor universe or just, your employees. So start where your problems are, start where the business issues and needs are, but then build it, build the consensus and build the journey to a community of stakeholders who work together to accomplish a business strategy.
And that's a great concluding point, because it really is about fostering alignment of everybody toward your stakeholders. This is a quick thank you to the many companies that are supporting the Enterprise Engagement Alliance's outreach efforts. Here's a quick slide that shows our services while I give you a quick summary here of what we covered today. And Amy, Dorian, and Eric, and Nick, can't thank you enough for sharing this video, which is going to be alive for at least a year until we update it again. We'll be marketing it regularly on our EEA Zoom channel. But I think it's a quick summary for everybody. Human capital reporting is here to stay. It's being driven by multiple forces that can no longer be ignored. It's going to be appearing also in the accounting profession. There's greater pressure now for there to be reporting coming up in the accounting field. Another key thing is that which gets reported, it gets measured. Another ironic element of this is that beyond the SEC now requiring human capital disclosures and big companies now requiring corporate sustainability reports out of their vendors, we're actually seeing the ironic issue where the whole focus on diversity, equity, and inclusion disclosures is forcing, or part of that larger discussion of human capital disclosures. So there's a symbiotic push where this concept of stakeholder capitalism that some of you have heard about, human capital reporting, is helping to drive more effective DEI reporting, and vice versa, which is a very ironic and wonderful thing. I think another element that we all have to, this isn't a bright, shiny object. This isn't a PR a process. It's the way you manage your business, and that the whole concept of DEI is a profit center. Part of the whole human capital management, it's about adding shareholder value, and it's creating social justice through capitalism. And that is indeed stakeholder capitalism, which we believe, my organization anyway believes, is the reform movement for capitalism that we've all been waiting for. Well, anyway, thanks for having, thanks you, our guests, for sharing your knowledge, and thanks viewers throughout the year who are enjoying this, their expertise. Have a great day.
Thank you.